Hello, my name is Mark Dauberman, Senior Editor at Roger CPA Review. Today we're going to be talking about the Auditing Standards Board's Clarity Project, probably the most significant change to auditing standards in several decades. Before I do, however, there's something that I want you to keep in mind, and I hope you will take this seriously. This represents a huge change not only in the way CPAs will perform audits, but more importantly to you, the way it will be tested on the CPA exam. If you can get your studying done now and pass this auditing section before these new clarity standards come into effect, believe me, you will spend much less time studying. Unfortunately, you're going to have to learn them anyway when you get into practice, but let's not make that a stumbling block that prevents you from passing the exam. Let me tell you a little bit about what these clarity standards are all about and highlight for you some of the most significant changes that they incorporate. We're going to talk about changes from 4 standpoints. The first type of change was they changed the format of the standards. Secondly, they added some additional requirements. Third, they added some new terminology and definitions. And finally, and most significantly, they changed the entire audit report. Now, we're not going to be able to go into detail on a lot of these, but let's hit the main points and make sure that you understand not only their impact, but how they might impact future CPA exams. First, let's talk about the format of the clarity standards. In order to make them easier to understand and easier to follow, the clarity standards are written all using the same structure, which consists of several sections. The first section of the standards is now the introductory section. To be honest with you, not something that's going to be significant for exam purposes. It's rather something that tells us when this particular standard applies and, quite frankly, when it does not apply. The second section, far more important both for practice and exam purposes. The second section of each clarity standard is called the objective. And this is where it talks about what we are trying to accomplish by completing what this standard asks us to do. Now, it's very important that we understand the objective from 2 perspectives. Number 1, as a practitioner, in order to make certain that we've complied with generally accepted auditing standards, we need to understand these objectives and make certain that they've been fulfilled. From your standpoint as a CPA candidate, this is the perfect type of question that we often see on the exam, where they might describe a standard and give us 3 or 4 different objectives. In reality, they'll give us 2 or 3 real objectives, and maybe 1 or 2 that are kind of made up, and ask us to identify the objective that belongs to this particular standard. Or they might indicate an objective and then list the topics of 4 different standards and ask us to identify which standard this objective pertains to. Understanding the objectives as they're spelled out in the Clarity Project will be really important for you, not only as practitioners, but also in preparing for the exam. The third section is called definitions, and quite frankly, irrelevant for you probably for exam purposes, because as you're learning the other aspects of the Clarity Project, the definitions that pertain to what you need to know for exam purposes will be incorporated in them. But it does indicate what terminology relates to that particular standard. It indicates what the term is and what the meaning of that term is. The fourth section is probably what you would call where the real meat of the standards is. It's called the requirements section. That is where all of the requirements that need to be fulfilled by the auditor are contained. If an auditor wants to make certain that they've complied with generally accepted auditing standards, they need to understand what each of those individual requirements are and make certain that they've got something that they have done, some audit procedure that they have performed that fulfills the requirements of that particular standard. Finally, the last section of each standard is referred to as guidance and explanatory material. And basically what it does is it provides additional information that will help us understand what the requirements are and how to fulfill the requirements. So for example, the requirement might indicate that the auditor should read the financial statements, and then in the explanatory material referenced to each paragraph of the requirements, it would indicate the goals in reading that material, what it is that we're looking for, and what conclusions we might need to draw from reading the financial statements. The clarity standards also introduced several new terms. And let's quickly and briefly go over some of those terms. These terms are the type that are likely to be tested on the CPA exam, and one of the things we're going to have to be careful of once the clarity standards are tested is I think that on many multiple choice questions, they'll be mixing terms, using some of the old terms and the new terms, expecting us to make certain that we pick the new ones. Again, another reason to get this exam out of the way before you have to learn this new material. But let's go through it nonetheless. The first major term that it introduces is the applicable financial reporting framework. Now, we always refer to GAAP, and then we refer to an alternate reporting approach, such as the tax basis, the cash basis, the modified cash or modified accrual basis, or for that matter, IFRS. Basically, what this standard or set of standards has done is they've taken all of these, including GAAP, and simply developed the generic term, the applicable financial reporting framework. The theory is an audit is an audit is an audit. If you're going to perform an audit, regardless of what method of accounting has been applied to preparing the financial statements, the goal of an audit is pretty much the same. And so it's established these auditing standards that apply regardless of what the applicable financial reporting framework is, but does establish requirements, as you'll see in a moment, to make certain that the framework that is selected is appropriate under the circumstances. Another term that changes is the old explanatory paragraph gets replaced by two new choices. Now, no explanatory paragraphs. Instead, we have an emphasis of a matter paragraph or an other matter paragraph. As the name implies, an emphasis of a matter paragraph is used to emphasize something. And so we can't emphasize something if it's not known. This is only applied when something is properly accounted for and properly disclosed in the financial statements, and we use this paragraph as a means of drawing attention to it to make sure that users of the financial statements are aware of it. An emphasis of a matter paragraph will refer to where the item is in the financial statements or the disclosures and simply draw the user's attention to it. Secondly, we have an other matter paragraph. An other matter paragraph is used when the auditor wants to convey information that's not required to be disclosed either in the financial statements or the footnotes to the financial statements, but the auditor believes that users will find it helpful in understanding what the auditor's responsibilities are, what an audit is, or in better understanding the report. Like an emphasis of a matter paragraph, an other matter paragraph is always shown after the opinion paragraph in the audit report. The next change in terminology was related to an area when an auditor is responsible for consolidated financial statements. When we were responsible or currently responsible for audited financial statements that are consolidated, we might be in a situation where a subsidiary might be in a different part of the country, might be in a different country entirely, might be in a business about which the industry for which we don't really have the expertise in. And the bottom line is, in many cases when we are auditing consolidated financial statements, there are certain parts, perhaps certain subsidiaries, that might be audited by other CPAs. We used to call the auditor that was responsible for the consolidated financial statements the principal auditor, but the clarity standards changed that term to the group engagement auditor. And in fact, the engagement partner is now called the group engagement partners. The auditors of the different subsidiaries used to simply be called other auditors. Now we refer to them as component auditors. These are auditors that are auditing components of the consolidated financial statements. I mentioned earlier the third change that was affected by the clarity standards is that they added several requirements that did not exist in the standards before. And let's go through the major ones of these. There are several minor requirements that we won't take the time to go through today. The first relates to that change in terminology we talked about. You'll remember that now they refer to the applicable financial reporting framework. Well, now anytime the client is not using GAAP, we as an auditor have a responsibility to make sure that the framework they are using is appropriate under the circumstances. So we have to make certain that we understand the needs of users and make certain that those needs will be met through this framework, that the client will provide all of the appropriate disclosures, and that there's not some alternative framework that would be more appropriate under the circumstances. Secondly, we now require management to agree that they have certain responsibilities in relationship to the financial statements, and we are required to obtain their acknowledgement of these responsibilities before we can even commence the engagement. The two responsibilities that management must agree to acknowledge are, number one, they are responsible for the preparation and fair presentation of the financial statements in accordance with the applicable financial reporting framework. Secondly, they are responsible for the design, implementation, and maintenance of internal control relevant to financial reporting. Now, even though these are things that are introduced into the auditing standards by the Clarity Project, these are two sentences that you want to be familiar with because they are involved in many aspects of the CPA exam. You will see these are on the compilation report, on the review report, as well as the audit report. Remember, management is responsible for the preparation and fair presentation of the financial statements in accordance with the applicable financial reporting framework. And management is responsible for the design, the implementation, and the maintenance. Remember all three. And I don't know if it helps, but it's kind of a dim prospect. Design, implementation, maintenance. We have to make sure that management accepts responsibility for those three items in relation to internal controls relevant to reliable financial reporting. Also, a minor area that we won't spend any time on, there are some standards called the quality control standards that firms that are involved in auditing or accounting practices are required to comply with. One of the things the Clarity standards do is they incorporate these quality control standards right into the auditing standards to make certain that the auditor knows that they apply to their auditing engagements as well. Probably the most comprehensive of the changes are those that relate to the auditor's report. The new auditor's report has a couple of significant changes. First of all, it now requires subheadings, so every paragraph will have a subheading so the user will understand what is included in that paragraph. Secondly, there are certain there's a new paragraph that's been added that now explicitly states what management's responsibilities are. I know you know how that paragraph reads because it's those same two sentences we spoke about a moment ago. So let me describe for you the new standard or unmodified report that results from audited financial statements. We start with a title. That title is required to indicate that it is the independent auditor's report. It's required to have the word independent in the title. Secondly, we have an appropriate addressee. It may be the governance, the audit committee or board of directors. In a closely held company, it may be management. In many cases, it may be a third party that's asked us to audit the financial statements of another entity. That is followed by what is called the introductory paragraph. The introductory paragraph is required to do a few things. It identifies the entity. It indicates what specific financial statements were audited, including naming each specific financial statement. It indicates that the financial statements were audited, and also indicates the date or period that the financial statements relate to. So the balance sheet as of, and the income statement, statement of cash flows, retained earnings, etc. for the period ended, and then we would provide the date accordingly. The next paragraph is the one that's been added that I've already talked about, and I bet you already can anticipate what it is that we're talking about. Management's responsibilities, which is what that subheading will say. And you know what it says already. Management is responsible for the preparation and fair presentation of the financial statements. Management is responsible for the design, implementation, and maintenance of internal control relevant to financial reporting. After describing management's responsibilities, we next have a section that describes the auditor's responsibilities. And the primary thing that we are trying to convey is the auditor is responsible for performing an audit in compliance with generally accepted auditing standards. Now, we can't expect users to understand what generally accepted auditing standards are, so we include a little information. We indicate that it requires us to plan and perform the audit to obtain reasonable assurance. It indicates what the limitations of an audit are. It indicates that we are going to be evaluating management's judgments and significant estimates, and basically talks about both what an audit is and, equally important, what an audit is not. Then in an unmodified report, the last paragraph would be the opinion paragraph. And this is where we would indicate that in our opinion, in all material respects, the financial statements present fairly the financial position of the company and the results of its operations and its cash flows. And notice that unlike the introductory paragraph, we don't need to name each statement, because by indicating that financial position is fairly presented, that results of operations and cash flows are fairly presented, it incorporates all of the financial statements that together provide that information. The report then is finished up with the signature of the auditor, the address of the auditor, which is either their city and state if they're in the United States, or their city and country if they're outside of the United States, the city from which the report is being issued, and then finally the date, which, as you know, and it hasn't changed, is the date on which we've accumulated sufficient appropriate audit evidence to support our opinion. So let me just add a couple of things about the report, just so you will be aware of them. These relate to situations where we might be issuing a modified report. Number one is we might be adding an emphasis of matter paragraph or other matter paragraphs. Emphasis of matter paragraphs go immediately after the opinion, and then other matter paragraphs go immediately after emphasis of matter paragraphs. If we're going to be issuing a modified opinion, that might mean it will be a qualified opinion, an adverse opinion, or a disclaimer of opinion. Again, not changed by the Clarity Project. However, what is changed is the way they're reported on. If we have a qualified opinion, we will have a paragraph with the heading Basis for Qualification, and it will be before the opinion paragraph. If we have an adverse opinion, that paragraph before the opinion paragraph will be Basis for Adverse Opinion. And if we have a disclaimer, I bet you could guess this one, Basis for Disclaimer of Opinion, also before the opinion paragraph. To wrap up, let's talk about how this might appear on the CPA exam. And what I'd like to do is share with you an exam question that was released by the AICPA in 2012. And first we'll go over this question the way it was originally presented, and then I'd like to show you how I think it might be presented after the clarity standards are tested. So follow along with me. The question says, in which of the following should an auditor's report refer to the lack of consistency when there is a change in accounting principles that is significant? And here are the choices. First, the scope paragraph. A change in accounting principles that affects consistency does not in any way affect the scope of an audit, so it would not appear in the scope paragraph. Number 2 choice, or B, is opinion paragraph. That's also not correct, because if a change in accounting principle that affects consistency has been properly reported, properly accounted for and disclosed, then we're not issuing a qualified opinion, we're issuing an unmodified opinion, and the opinion paragraph will not refer to the lack of consistency. Of course, if it wasn't reported or disclosed properly, now we're dealing with a qualification because of a departure from GAAP, which is not what this question is about. The third says an explanatory paragraph following the opinion paragraph, and that is correct. A consistency issue, since it's not qualifying the opinion, this would be providing additional information about something that is disclosed in the financial statements, and it follows the opinion paragraph. The fourth says an explanatory paragraph before the opinion paragraph, but we know only the reasons for changing the opinion are before the opinion paragraph. If it's additional information, it's after the opinion paragraph. So best answer there was C. Now, in my view, if they were going to ask the same question after they start testing on the clarity standards, I don't think the question itself would change. It still would probably read, in which of the following should an auditor's report refer to the lack of consistency when there is a change in accounting principles that is significant? But now, I think the choices would read somewhat differently, and let me tell you what I think some of the choices might be on a question after the clarity standards are tested. I think they would probably see if we wanted to include it in the opinion paragraph, and we have to remember this doesn't represent a change in the opinion, so it doesn't go there. Second, they might say an explanatory paragraph following the opinion paragraph, thinking that that's what the answer used to be. And one of the things they like to do on the CPA exam is they like to give choices that sound like they're right, either because they used to be right or because they're close to what would be right. But that's no longer the correct answer. No longer do we have explanatory paragraphs. C says an other matter paragraph following the opinion paragraph, but again, we know that's not correct because an other matter paragraph is used only to provide information about something that's not reported on and disclosed in the financial statements, which a change in accounting principles would be. The last choice is the correct one, an emphasis of matter paragraph following the opinion paragraph, since a change in accounting principles is, in fact, properly disclosed and reported in the financial statements, or it's a departure from GAAP. If the only issue is consistency, then this would be reported in an emphasis of matter paragraph after the opinion paragraph. As the senior editor of Roger CPA Review, it's my responsibility to make certain that we are aware of any changes to the accounting profession that might have an impact on the CPA exam. Our pledge to you is that we intend to stay on top of these changes and offer you the best materials in the marketplace, the most up-to-date, with the best approaches and techniques that will ensure your success on the CPA exam. I hope you found this presentation informative and interesting. Thank you.